Ray Attrill, who is Global Research Director at Forecast. So, Ray, welcome to you. Thanks so much for joining us. So tell me, what are your expectations with regards to these stress tests? We heard the EU, the latest that they're saying is if banks do need capital, then they should go to the markets first before going to the government. That's a little bit easier said than done, isn't it?
Well, remember when we go back to the US stress test in 2009, we had an announcement on the day of the stress test results that banks collectively needed to raise about $75 billion, and we had immediate pronouncements from the banks that had failed the tests that they had plans in place to raise that money from the market. So I think we're going to need similarly smooth responses to the outcomes of the stress test. But as in that segment you just showed with the Greek finance minister, it's fairly clear that EU ministers are, if necessary, willing to mobilise the European Financial Stability Facility to provide for some sort of partial nationalisation of the banks. I think that's the backstop that's in place here. I think the other thing is the market's still pretty uncertain about the exact form that the stress tests are going to take. You mentioned 17% haircut potentially on Greek debt and possibly even something on German debt. We don't know what the macroeconomic stress tests are going to be. And I think the market will take the view that if all banks are seen to have passed the tests, other than perhaps some of the German Landesbanken and the Spanish Caja savings banks, then I think the market will take a little bit of a jaundiced view on how credible the tests are. So there's a real fine line, I think, for tests that are credible that will imply quite a few banks in need of capital and something that will frighten the horses.
Well, this is it. I mean, how would you describe market expectations for these tests? And we have seen the euro rise about 6% in the run-up to these stress tests.
That's right. I think that's the fear that I have. I mean, obviously, if everything goes very smoothly, the tests are seen to be credible. We see immediate pronouncements on capital raising, and that capital raising, I think, is going to have to be in the many tens of billions of euros to be seen to be credible. Then maybe the euro can sustain the gains that we've seen. But I think what you're alluding to is the fact that we've already bought the rumour on credible stress test results, and the danger, if there's any disappointment, we could see a sell the fact response.
Now, Ray, you told us last month when we spoke to you that you expected the euro to fall as low as $1.05 within a year. Do you still hold that view?
Yes, we do, despite the rally that we've seen in the last few weeks. I think the underlying source of the euro recovery, apart perhaps from optimism about the stress tests, is the fact that we've clearly got some pretty weak US numbers in the last couple of weeks. That has driven US Treasury yields down relative to Eurozone and particularly German bond yields, and that's been the key driver of dollar weakness. We do think that this is probably a mid-cycle slowdown in the US, that the Eurozone probably has one to come, if not a move into a double-dip recession, and that some of the moves in yield spreads that have been a key euro-dollar driver are likely to reverse later this year and next year, and that could then be the driver for a resumption of euro weakness. Plus, of course, none of the structural issues that have been drivers of the euro weakness earlier in the year have really been dealt with. They've really been deferred to the future, and we do think they are going to come back to hit sentiment quite hard at some point, perhaps not now though, until 2011.
Okay, Ray Attrill, Global Research Director at Forecast, thank you so much for joining us.